It is just after 10 o'clock, so I will start the formal part of the webinar. Thank you all for attending. We really appreciate you giving up your time. And for those that just heard Nick and I chatting, we're just marveling at how efficient this delivery method is. And we hope you're finding that as well. We know that you're probably getting bombarded with webinar requests, but the good thing is that it is really time efficient and the technology works really well. Apart from not being able to see Nick or I as was originally planned, but what we will do is just progress. You should all be able to see Nick's presentation, so he'll speak to that throughout. If anyone has any questions, just let me know. You can either email me at staylor@gsfm.com.au, or you may be able to do it through Zoom, but the first preference is to my email. And what I'd also like to say is that the Munro partnership with GSFM has now been going on for a couple of years, and it's been really pleasing for us. A lot of you have met Nick in person up in Brisbane and have been following the fund. Some of you are newer to it and may be looking at doing your first investments. But what I'd like to say is that, if you ever wanted to look at potentially placing client funds into a new offering, you've got such a fantastic period over the last 3 or 4 months to see how a fund may perform in a time of high duress. And it's been really pleasing for us to have investors have a good outcome over the last few months from Nick and the team at Munro. So every morning we get the feeds from the US and global markets, and sometimes it makes sense, sometimes it's a bit random, but one of the great things with Nick and the team is that they've been able to put a filter through all that and try and make some rational decisions for clients. And what I'll do now is pass over to Nick to give a rundown of where he sees markets currently, a bit of history, and most importantly, what he thinks it's going to look like for all of us over the next year or so. So I'll hand over to Nick now.
Yeah, thanks, Dave. And I'm pretty sure everyone can hear us. I can see the participants online. Gary's even made a comment about Zoom. He's done 65 meetings in the last 2 months, so he agrees. I think I've done 65 as well, Gary. But yes, if people want to use the chat function, try to keep it really interactive. I'm not sure if you can drop yourself off mute, but otherwise email Steve, because I'll give sort of a quick 25-minute or 20-minute sort of appraisal just to talk you through what we've done sort of year to date and how we did it, and then try and give you some views as to where we go from here. And at the start, I'll just very briefly remind people who we are. So look, Munro Partners, and so hopefully you can see the slide presentation. Look, for those of you who've met me before, you might have seen me up in February. We're a global growth investment manager, core focus on growth equity. So the goal of the business when we set it up, put simply, was we wanted to be global equities, but we wanted to offer the growth version. So if platinum was absolute return value, we wanted to be absolute return growth. That is really the simple way of thinking about it. And we knew when we set the business up that growth was massively underrepresented in the Australian marketplace in particular. And we had some fairly strong views about how the world would evolve, and it has evolved that way. And if anything, COVID's brought a lot of that evolution forward, which is exciting, but it means things are now moving very quickly. Fund started in July 2016. We've done 15% per annum. We actually have a 10-year track record from our previous firm where we also did 15% per annum. It's important to stress that we don't do it every year. So it's a correlated product. And the best way to think about this product is as a global equity manager with some downside protection. We have nearly $2 billion under management today. I'm not going to spend a lot of time on this because you guys have seen it before, but just as a growth manager, it's important to remember we're trying to find these structural growth opportunities like MasterCard, and we just basically don't care about these companies that are basically macro stocks because we just don't think we've got an edge on the macro. And so we really want to drill down on these structural opportunities because the world's going to change, and you want to find those winners. And the reason why we do that here on slide 5 is because we just think it's all that matters. And the longer I work in this industry, the more and more I feel strongly, and we feel strongly as a group, that it's just horribly, horribly overanalyzed and horribly, horribly oversimplified. And so the key point to remember about equities is it's a game of very, very few winners. And there's always lots of losers. That's how the equity market works. It's not a bond. It's not a currency, okay? Equities is a game of few winners and lots of losers. I've shown this slide lots of times before. We're going to talk about the few winners of the future today. But if you look at the US market, the top 50 companies over the last 90 years make up 40% of the value of the US market. So 50 companies out of 25,500 that listed over that 90-year time frame make up 40% of the value. And the top 1,000 make up all of the value. The rest basically either go to zero or just offset the companies that went to zero. So you have literally 50 companies that you're trying to find here. What we've done on the right here is trying to plot them in the life and months they've been around and the annualized returns. And so our point is they're always, and the reason why we're showing this is they're always driven by big structural changes, big revolutions. So right now we're having a digital revolution, which is Amazon, Facebook, Google, Visa. I think people understand that now. But over time, you know, everyone sort of said, oh, this time it's different. It's like, well, no, it was always different for all these guys. You know, Home Depot and Walmart created the big box retailing revolution. McDonald's created the quick service restaurant revolution. Disney drove the entertainment revolution. Boeing drove the travel edge revolution, and Altria drove the cigarette revolution. So when cigarettes, so all of these were big structural changes that occurred in the economy, and all of them which created massive, massive value to these very few winners. And so our job as your growth manager is to try and find these very few winners. And so that's what we spend most of our time talking about. It's what we spend most of our time doing. It's how we're going to make your money in the long run. And I'll talk about the capital protection stuff in a second, but that's how we definitely make the money. Over 15 years, we've worked out the best way to do this is to go meet them. And so it's a relationship business. We don't use screens or you know, things that screen up a stock, because once you've screened it up, it's sort of already happened. So that's us doing 500 meetings a year. Zoom's also helped. Key point is to really focus on these structural areas of interest. So where's the next one going to come from? Is it going to be a big cloud computing company? Is it going to be a big healthcare company? Is it going to be a big luxury goods company? And so really drill down to this much smaller universe of 1,000 stocks to try and find those next big winners. That's what you're paying us to do. We run this in two strategies now. And so the one we're going to talk about lots today is the absolute return fund, because that's our flagship product. So that's your Munro Global Growth Fund. That is your flip side of platinum. So it has that downside protection tools. The goal of that product is to make you 10% per annum after all fees and expenses on a 3 to 5 year investment cycle. And that's what it's done. It's not trying to beat the market. It's trying to just make you that positive return. And it has some of these tools we're going to talk about. We have also launched the relative return fund. Look, we understand that some people just want to be fully invested in what we do all the time, and they can construct their portfolios accordingly, or they want to do their own capital protection. And so the Munro Concentrated Global Growth Fund was launched late last year, and it's just our top 20 to 40 long ideas, fully invested, completely unhedged all the time. And I can talk a little bit about that in Q&A, but I'm mainly going to be talking about our flagship funds today. And so the last thing that I just want to talk about in this quick introduction is how do you protect against the downside? And so we have now a period in March that can show you how some of these tools work. And so we're showing you how they worked in March. We're not saying they're going to work this well all the time, but we are saying this is sort of helps you get your head around how the product works. And so in the white is what we do and every other fund manager in the world does, which we have an investment team, follows an investment process, does active research, and it picks stocks with high conviction. We happen to be a growth equity manager. Lots of other people are value managers. And some people are bond managers. But that's what we do in white. That's how we make our money. That's how everyone else does it as well. And I just showed you how we do it as a growth manager. In the yellow bits are the things that we can do that most people can't do, which is we can hold up to 100% cash if we need to. We can buy a put option on the market, which we have done recently. We can short sell. We can run things like stop losses. So we can run a stop loss on a stock and sell it. We're not forced to buy another stock because we can hold cash, and we can actively manage the currency. And all of these are done with this capital preservation mindset. So the goal here is really, and this is the trick, and the goal is to come back to that 10% number I talked to you about. So we're not actually trying to beat the market here. We're not really looking at the market that closely. We're trying to make you 10% per annum after all fees and expenses through the cycle. And if we do that, we generally think you'll be happy, and we generally think that will probably beat the market. It won't be beating it at all different times, but over the journey, it probably will. And so that mindset allows you to make decisions like when there's a virus around, like there was in February, to buy a put option. I don't want to sell my whole portfolio, but this thing could be bad. So why don't we just spend 35 basis points of our performance buying a put option or put options on the market? And if we do that, it might work out. Now, a relative return manager won't do that because that's 35 basis points they're going to lose. But from our point of view, our constant fear is if we have a 20 or 25% drawdown in this fund, it's very, very hard for us to achieve our goal of 10% per annum over the cycle. And so what we're always thinking about is not losing money first and then making money second. Now, this obviously worked out for us quite well in March, probably a lot better than what we thought it would. And maybe I'll just show you a couple of details as to how it worked out, and that'll maybe give you some comfort as to how we use these products. So I think this is the March quarter performance. This is what the funds all did this is what markets did around the world. That's what the index did. Currency, obviously, in Australia was a good lever because it rallied. Market was down about 10%. In equity returns, we were actually up. We also had the currency gains, but not as much because the fund was not completely unhedged for a 7.6% return. Just if you go into the details, so I'm just going to focus on this little bit here, or this bit here, basically. For our fund, it wasn't because we picked great stocks. We lost money on our long book. The long book fell 12% in the quarter. It didn't fall as much as the market for two reasons. The first is because, we had a lot of tech stocks already, so we were positioned for the new winners already, i.e. Microsoft, Amazon, etc. The second reason is we exercised our stop losses. So the mistakes we had made, the things that we did own that were in trouble, like Airbus or like Kering, we stopped ourselves out of those really quickly. We recognized that something had gone wrong and that we should just move to the sidelines. Doesn't mean we won't come back, but we'll move to the sidelines. We moved to the sidelines on Airbus when it was down 20% from its peak. It ended up falling 60. But what really helped us is obviously our short equity return. So, and I'll show you in a second, shorts added 6.4% and hedging added 6.7%. So this is the stuff we do to hedge that. And I'll show you in a second what we used. And then the currency added 7. So just showing you again in a bit more detail, these are in basis points return, and this is all in our quarterly reports. These are the top 5 winners for the month, not very many, top 5 losers. Wish we hadn't done some of them. Everyone had that situation in March. And usually it was the companies that were like Uber, etc., that were really at the epicenter of the crisis. The shorts, all of these shorts, the top 4, we actually had them all on before we did it. Before the quarter hit, and we did push them harder through the crisis. And down here you have the put options. So these are that 35 basis points here ended up being 200, which we then rolled into March and continued to use put options to protect the downside. The last and hardest bit about what we just went through was when to get reinvested, not to get reinvested, when to take these hedges off. And so this is actually the net exposure of the fund since inception. So it is a variable beta product or a correlated product. These are the shorts over that time frame. And so you add them together, we're spending roughly 100% of your money all the time. As you can see here, exposure drops dramatically in March. That's not us selling the whole portfolio, okay? So the whole portfolio stayed roughly the same the whole way through. Only one of the top 10 stocks actually got sold, which was Airbus. But exposure dropped dramatically because the put options explode in value and because we pushed shorts a little bit harder. And then in March, we obviously closed a lot of that hedging and we started closing the shorts. And the exposure went back up again very quickly. And ultimately that left us back in a fully invested position pretty much by the week after Easter. And yeah, so that's how the product works from a capital protection point of view. That's what we did in March. That's who we are. But what you're probably most interested in is where do we go to from here? And so let me just explain why we did what we did and then what we think will happen going forward. So why we did what we did is really important. And I'll give, if I'm repeating some of the stuff I did on the webinar, I apologize. But I am showing you just updated versions of similar pictures because obviously our view evolves as we go through the crisis. And what we learned sort of about halfway through this crisis is that COVID-19 is different from most recessions because it's sort of no one's fault. No one deserves to go broke because of COVID. And so from that point of view, governments are hurling stimulus at this. They are doing everything in their power to try and keep you solvent. And solvency is a big issue in this crisis. And so they're hurling essentially the largest amount of stimulus we've ever seen. And this is, it's adding up to more than $10 trillion now. And as a percentage of GDP, this vastly outweighs anything we saw in the financial crisis. Financial crisis, I think at best, the US got to 15% of GDP. And so this is to try and get you across the bridge to not drop you down that valley. The second thing that's happened is what the Fed's doing. So the Fed has, this is a chart of investment grade credit in the US. What you're seeing here is the issues that happened in credit markets. So normally when you go into a recession, credit markets seize up and you can't get capital. The Fed knew this and decided that that wouldn't be fair because it's no one's fault. So they stepped in and started buying investment grade credit at the back end of March, and then they started buying high yield credit on the other side of Easter. And what that meant is credit tightened all the way back to where it was before. And so people who needed to borrow money could. So you would have seen Boeing raised $25 billion at 5%, or Carnival raised $4 billion. Carnival Cruise Lines actually borrowed $4 billion at 8%. And so companies that otherwise may have gone insolvent are not, because they can access credit markets. And credit markets are wide open. So you've had the best 3 months in corporate bond issuance in history. And so companies have made more credit, double the amount of credit this year than they raised last year, so more than $1 trillion. So that means no one's going insolvent anytime soon because they've got access to credit. So again, very different to a normal recession. Last thing I'd just say that makes this a bit different to a normal recession is the S&P 500 is not the economy. It never has been, and it's worse in 2020 than it was in 2008. So these are the top 10 in 2008. These are the top 10 today. And it's actually quite hard to find a company in the top 20 of the S&P 500 that is worse off because of COVID. They're all actually probably better off. And for most of the S&P 500, it's important to understand that this is a small business problem. So a lot of us have had friends and family who are in difficult positions now, and it's very sad because they've been forced to shut their business. But those small businesses don't have access to credit. They don't have access to the credit that these companies have access to. And they probably don't have the balance sheet that these companies have, and they don't have access to equity markets as well. And so from that point of view, big business can prey on small business here, and they will, because that's how capitalism works. And so from that point of view, we do think even the companies that are in a bad position can take quite a lot of share here. And then there's a whole bunch of companies that are in good position that I'll talk about in a second. So all of that suggests that the market should go back to its previous highs. And we sort of worked that out through the first weeks of April. We are surprised that it got back here this quickly. So I'm not saying we don't think the market should be where it is. We do, but we do think it got there a little bit quicker than we thought it would. But I suppose if we could work it out, then everyone else worked it out pretty quickly as well. Okay, looking forward. What are we doing as growth managers? Something important to remember here, okay? So this is the holy grail of what we're looking for, the S-curve of adoption. I'm showing you this one as one that happened over history, and so one that we're all acutely familiar with, which is the global mobile phone market. But I'll try and bring this into the global world as an analogy in a second. So in 2008, you used to sell 1.6 billion phones per annum. 2018, you sell 1.7 billion phones per annum. So phones don't grow. We buy a mobile phone once every 2 years globally. And like the economy, it's flat. And you know what? Going forward, the economy is going to be flat as well. at best. But smartphones go from a 10% share to an 80% share in the space of 10 years. Apple rides this wave and goes from $50 billion here to $1.2 trillion here. That's what you're looking for. And in this bar of winners in smartphones, there are two companies, Apple and Samsung. And in this bar of losers, there are like heaps. Nokia, Ericsson, Motorola, Alcatel, etc. So it's a game of few winners, lots of losers, big structural shift, all the stuff we talked about at the start. These are the big structural shifts we've been following that I was talking about in February, if you saw me. And as you can see, you can see e-commerce is slowly taking share from regular commerce. Digital payments are slowly taking share from cash over long periods of time along the bottom here. But what's interesting about this crisis is that all of these structural shifts that we've been following and investing in for these structural growers will actually accelerate in a post-COVID world. So the simple one being card to cash used to be 35% card, 65% cash. It's now 60% card, 40% cash. On that trajectory, cash would have disappeared 15 years, 20 years from now. What we actually think is cash will probably disappear in 5 years now. So this is going to accelerate. And so these winners, even though the pie is smaller, their share of the pie is bigger. And so we're having to upgrade earnings for these companies. It's pretty much the same for digital advertising, just because event advertising and in-store advertising and etc. are down, then that budget is moving to digital. So even though advertising budgets are down, digital share is up, and so they're net better off. Cloud computing is just net better off. So the shift to the cloud, or the shift to Zoom adoption, as we were talking about at the start, is just straight accelerating. And so these companies are not talking about earnings downgrades, they're talking about earnings upgrades. And the last one is e-commerce. It took you 20 years to get to 18% of all retail sales being by e-com. And in the first 5 months of 2020, you got to 25%. So the last 7% has been added in just 5 months. So again, the pie is smaller, but Amazon and Alibaba's share of the pie is bigger. So we are probably upgrading earnings for these companies. Now the market's worked these out. And so a lot of these companies have moved back to all-time highs. That makes sense. But if anything, they should go further. And so these are the main companies we invested in at the lows, because we couldn't work out why they were down. They should have been up. Microsoft was down 20%. It should have been up 20%, because we all need their products. And I know they're going to have some clients go insolvent, but that's going to be far outweighed by the people who are actually using the product more. Other areas we're really focused on is biologics. So here you can just literally invest in the companies that make the vaccines that we're clearly going to have to roll out around the world, and the capacity. So there you're looking at things like Danaher in equipment, Thermo Fisher in testing. Clearly testing is going to be with us for a long time. Lonza as a contract manufacturer of vaccines are the three big investments there. And then over on the right here, semiconductors. We still like semiconductors. Semiconductors are the weapons manufacturer in this war. If you look at the Australian Track and Trace app, it's an app that goes in your phone that's designed to track you. It runs on Amazon Web Services. Everything is going to be tracked everywhere for a long period of time. And this is happening anyway because of 5G and the Internet of Things and artificial intelligence. And so semis, people think they're cyclical, but we actually think they're structural. So these are companies that you can buy at really quite good valuations today, where you get the economic uplift and the structural uplift. Last area we still like is clean energy. It did get unnoticed through the crisis, but OPEC broke. We thought that would take a couple of years. It was 2 or 3 years away, but it happened in the crisis. And so as OPEC has broken, it's very hard to see how the shift to clean energy doesn't continue from here. And energy is going to be a bad place to invest. And if anything, the stimulus that comes in to the market will focus on some of these clean energy alternatives. On our shorts, so most of the shorts we closed, mainly because they worked very well and we made a lot more money than we thought, as I showed you before. But we closed all the energy shorts, the tourism shorts, the media shorts. We will look to short again. So I understand why banks and autos and cyclicals are bouncing or value is bouncing. I understand why it's bouncing, and that's why we closed our shorts. But I don't think we want to invest there. I think it is a trade. So a bank can bounce back to maybe 10% below where it was before, or maybe 15% below what it was before. But I do struggle to see how the economy is going to grow aggressively from here. And I know that this issue between big and small businesses means that the small businesses is really, unfortunately, the epicenter of this crisis, and eventually that's going to end up at a bank. And so when JobKeeper comes off, or when we all eventually get back to work, slowly but surely, unfortunately, there is a recession still to come. And slowly but surely, a number of these companies will give up. And unfortunately, that will end up at a bank. It'll be the same for the autos, who are essentially, subprime lenders to people who buy cars. It's the same for the restaurant companies who use franchisees. And so these are the areas that we would look to short if they bounced high enough. And we have started to put a little bit of that back on, but we are cognizant that there's probably a little bit more of the rally to go before it's time to do that. But what we are really focused in on is this slide here, which is slide 22. So who's going to be better off in the long run? So yes, I understand there are trades here and some of this beaten up stuff. But what we really want to focus on is like who's going to win in the long run. And what are the key winners? Because there's a lot of companies that pretend to win in the long run, and our job as your growth manager is to find the ones that will. And trust me, we'll make our fair share of mistakes along the way as well. But these are the areas that we need to focus on. This is the digital enterprise, which is cloud. It's roughly 17% of the fund. 6 holdings, Microsoft's the biggest. It also includes things like ServiceNow, Atlassian, Viva Systems, Adobe. Digital payments we've sort of discussed. I won't go into detail, but we still think it does well. E-commerce we've discussed, won't go into detail. Internet we've discussed also. Healthcare, this is a big area for us. It's getting bigger all the time. These are the companies that will build the capacity that's going to allow us to go back to our normal way of life, which I do think will happen. And so that's your Danaher's, your Thermos, your Lonza's. The semiconductors we discussed. These are your weapons manufacturers in the war. So this is your ASML, your TSMC in Taiwan, your NVIDIA, and then climate. In terms of areas we'll be adding to, I suspect the climate area is going to come up, and I suspect the health area is going to come up, just because these stocks have done well, and I think they'll continue to do well, but they may take a break for a little while. But over the next 3 to 5 years, I think it's reasonably obvious to most people that we're probably looking in the right areas here. And over the next 3 to 5 years, we think these areas will see strong structural tailwinds. And those strong structural tailwinds will lead to strong structural earnings growth. And that strong structural earnings growth should ultimately lead to strong share price growth. Things that would worry us along the way. So this is the fund as it was at the end of May. And so you will see we are reasonably fully invested here at 90-odd%. The top 5 has not changed much. If anything, it's just got a bit more big cap. There are smaller companies in the fund, but they're not as highly weighted as they were previously, and they're down here. The delta adjusted return is below the actual exposure, so we have started buying put options again, only in the last couple of weeks. And the reason why we have done that is while we don't believe in a second wave, and let me rephrase that. We don't know if a second wave is coming, but we do know that a second wave, if it is coming, it's coming in the next 6 weeks. And so markets, I agree, have got here faster than we would have liked. We still like these opportunities in the long run. And so all we're doing is putting a little bit of a safety net in here to protect against the downside. That said, as I said, I think a lot of people can see what we see already. And so if you're looking for markets to pause or to pull back dramatically, I'd be surprised if that happened, unless there's a large rise in the second wave. And so that's just something to think about, because ultimately, as we get through to the second and third quarter, you're going to actually see some results from some of these companies that are going to show the acceleration that we're talking about. And people are going to start to realize what we're saying and what I think other people are saying as well. And so from that point of view, you really are, if you want the market to pull back here, you really are counting on a second wave. If it's going to happen, it happens in the next 6 weeks, and so that's why we've got some put options in there. Yeah, last thing I'd just say is on performance. Performance is here on slide 24. This is your per annum. The key thing for us to focus on here is this per annum return number. So we really are focused on making sure that stays above 10%. That's really our core focus. Over the journey, as I said, there are positive and negative months, but if we do that, then we think that'll be happy. The beta we're running is below the market, even though the stocks we're investing in have a beta above the market, and that's really some of those capital protection tools we use. 0.7 is more like our long-term average, so 0.5 is just because we had a particularly good period in the March quarter. But ultimately, over the journey, if we find the right areas, invest in the right companies, their earnings grow, their share prices grow, that's going to lead us towards that 10% number, and the rest is just risk management. Last thing I'd just say is, look, please don't be afraid to go to our website. We're very transparent about what we do. There's the concentrated fund is the new one, which is here, which is a long-only fund, and there's the existing fund. And look, I can see some people online. We might try and take some questions, if that's okay, Steve, or I'll try and see if there's some chats in here.
Yeah, definitely. I haven't had any email questions, but if we have any on the chat, please go ahead. And just whilst we're waiting for a couple of questions, I think just in terms of the practicalities of how you access the Munro funds. So as most of you know, we're on pretty much all the main platforms. You can come to us directly through the PDS for 25,000 minimum, which we get a lot of support, especially for self-managed super fund investors. And there also is an M fund. So keep in mind that depending on what your specific objectives are, if you want the absolute return long short option, that's the flagship fund. But for those that might have clients that have a slightly higher risk profile or objectives, you're certainly welcome to go into the Munro Concentrated Global Growth Fund, or you may even do a combination of both. So if anyone has any questions around those afterwards, just let me know. Just seeing if we have any questions, and it doesn't appear that we do. So what I might do is just conclude, and thank you all for tuning in, and thank you, Nick, for your time as well. It's always really enlightening, and we enjoy hearing your views on the market. And I think for those clients that have been invested over the past year or so, they would be pretty happy with how it's gone, given all the market upheaval that we've seen. But as Nick pointed out, that's all in the past now, and it's more important to look forward and to try and continue that momentum, which we're currently doing. The final thing I would say is that most of you as advisors are probably tied up with year-end planning for your clients at the moment, but once we get into July, we will be doing another general Munro Partners webinar with Nick, just to cap off a financial year's performance. But also, when you are looking at perhaps doing some portfolio construction work, if you ever want me to do some modelling or analytics for you, I'm more than happy. If you want to send in different funds that you're looking at, we can model all the correlations and the likely outcomes to try and optimise the portfolio for you. So any final words, Nick, to finish up?
Yeah, no, I'd just say, look, I mean, I know people are nervous right now, and I would just summarise the nervousness with this. Is if you look at our portfolio, I'm reasonably confident we've got the alpha side correct. So I'm reasonably confident these companies will win. We're in one of these unique periods in time where most people can now see it, and I'm reasonably confident that they will win. Now, if the virus came back, then they would still be relatively better off. And so the beta side of the portfolio we can protect, i.e. the downside of markets, we can hopefully protect with some of our capital protection tools. And I'm pretty confident got the alpha side right. And then even if we're wrong on the alpha side, i.e. the world just goes back to normal really quickly, and there's this huge reflationary uplift, then any performance problems we have will just be relative. They won't be absolute. And so, because it'll just be all this other stuff bouncing. So from that point of view, we think we've got this right. And so from our point of view, we just really want to get this bet on and deliver for our clients in this area that they probably don't have covered. And so what we want to be is your global growth manager. And we want to be your global growth manager as either long only or long with some capital protection. And so at this time, as difficult as it is around, and I understand the second wave concerns and I understand the nervousness, I would just encourage people that this is stuff we've been looking at for 10 years and it's now being brought forward and it's accelerating really quickly. And so now, I think I was saying, if some of you dialed in at the start, I sort of wish this hadn't happened because we would be quietly just growing in the background and these companies would be quietly doing well. It's now going to happen very quickly. And so from that point of view, you should think about whether you've got a growth manager. And if you don't choose us, choose another one, that's fine. But I would have one at this point in time because it is going to happen quite quickly, I suspect, from here.
Thank you, Nick. And on that note, everyone, thanks again for tuning in. We really appreciate your support. And if you have any questions, please just let me know. More than happy to help out and try and give you any answers that we can. And we look forward to seeing you next time. So thank you.
Thanks very much.